Hello, good afternoon, everyone. This is Suzanne Friday with Council on Foundations, and welcome to our webinar on Hot Topics in Board Governance. I do have a last-minute special guest star with me today. My co-counsel, Brian Del Rosario, is here, and I asked him to step in and join us because he was recently at a seminar conference for nonprofit law where they did talk about board governance in some detail, so I think he might have some things to add. So let's just go over the agenda quickly, and hopefully everyone has the slides up. Oh, I'm sorry. First of all, my colleague Carolyn is going to go over some housekeeping items before we get started.
Yeah, so we are recording this, and the recording will be available on our website next week once it's ready. We will also be taking questions throughout the webinar, so if you go ahead and type it into the question box, we are monitoring that and we'll answer them as they come up. So that's what we have.
All right. Housekeeping. Thanks, Carolyn. All right, so agenda for this afternoon. This is an hour-long webinar, and hopefully I didn't get too ambitious here. But generally, what we're going to talk about, we're going to start with board-adopted policies, some general discussion of board policies, board-adopted policies. And some of the hot topics we're going to talk about, and I'm sure many of you have listened to presentations on many of these before, but you know, they keep coming up, and so we thought it was important to include them. We'll talk about conflicts of interest. We'll talk about self-dealing for private foundations folks out there. Then we're going to go into investment oversight. I've been getting quite a lot of questions in this area lately here at the Council, so I included that. Then another kind of trendy topic is mission measurement and mission drift. We'll talk a little bit about that. We'll wrap it up with a discussion of transparency and public disclosure. That's another popular question that I get here at the Council is, what do we as a foundation have to disclose, have to put out there publicly? We will talk about that. You can submit questions online, and Brian can help me monitor questions as they come in and answer them as we can. But as I said, we're going to talk a little bit about policies, board policies in general. And I want to make a very, very important point right now, is that you'll see on the slide it says a few legal requirements for formal policies. The IRS has a few requirements, but as nonprofit organizations, whether you're organized as a corporation or as a trust, you are a creature of the state law where you are organized. So it's very important to understand that every state out there has some form of nonprofit law that would apply to you. And within that nonprofit law, there might be certain requirements. So for instance, we as a council are actually organized and incorporated in New York State. So we need to be aware of the New York State nonprofit corporation law, which was actually amended a few years ago and updated with some new requirements. And we have to know what they require with respect to board governance and board policy.
I think that we're having a little bit of problem here with our sound, and we're going to try to see if we can.
We
do see some responses that
they're not being able to hear.
Here, the sketchy connection is not good, but we're going to see if we can remedy those.
Okay, and I apologize. Stand by for a few moments, see if we can fix this. If anyone can hear me, we here in the DC area are expecting a major winter storm. I don't think that has any influence here, but you never know. Okay, everyone out there on the webinar, I just got a new microphone. So if you are still having trouble hearing, if you could type that in. Right now, it seems like the only communication we have with you guys out there is if you type in a message. If you can hear me clearly, let me know as well. Is that working?
It looks like it's, but some people it's still breaking for others.
The messages that we are getting are that some people out there are having difficulty with the audio. Now, do they have a phone dial-in as an alternative to the computer? Yeah. Hi, we're still here. Should I keep going?
Yeah, let's see if we can try.
We're monitoring the messages, and I apologize. We're going to try and get this sound issue taken care of. So we're monitoring your messages to see. It looks like we're still seeing people that cannot hear. Okay. Everything is okay?
Anytime that's better. And we do have a request if we could go back.
Sure, we can start over again.
Start from the agenda.
Absolutely.
Yeah. Okay.
All right, let's start all over again.
Sorry, guys.
No problem. Okay. So, again, welcome to our webinar, Hot Topics in Board Governance. The first slide, I've outlined the agenda for the day. We are going to talk about board policies in general. Some of the hot topics, and as I always do with the webinars and the presentations that we as the council do, they are heavily influenced by your questions, the questions that I get day to day as part of my job. So I've included conflicts of interest as well as self-dealing as part of the agenda, so we'll talk about both of those topics. We're going to talk about investment oversight, which is being very popular right now. We're going to talk about mission measurement and mission drift, these kind of trendy topics, but I think important to talk about with respect to the board. And again, our webinar today is focused on the board, not so much staff, not to disuse staff people, but we really are focusing on the board and board governance today. Then finally, we're going to wrap up with the issues of transparency and public disclosure and some of the legal requirements that you guys have as foundations for public disclosures. Hopefully, we'll get some questions submitted that we can also answer. And as I said earlier, I have my special guest star, Brian Del Rosario. He's one of the attorneys here that works with me at the council. He recently attended a program where there was a lot of information about board governance, so I think he might be able to share some interesting things with us. All right, so hopefully we're in good shape right now. We're going to go on to the first slide. And when I talk about board policies, I want to make a couple of things really clear. First of all, these are the policies that your board adopts with respect to your foundation's governance. You know, the board is your governing body. They have the ultimate authority for running the foundation. They obviously delegate duties to staff people to carry out the day-to-day operations. The board is the ultimate governing body. And as the governing body, they have the ability to adopt policies that reflect on or guide the operations of the foundation. These may be different than, or you may have different policies for your employees. I'm sure many organizations have employee handbooks and employee policies. So that's not really what we're going to talk about today. Today we're talking about the policies that the board adopts that govern the organization as a whole. They may affect the performance or the roles of the staff, but these are board policies. The other important point I really want to make is that while there are few actual legal requirements. The IRS has a few. Your state law may have some. As nonprofit corporations or as trusts, you are organized under a particular state. You, at some point in time, incorporated your organization in a state. So therefore, you are a creature of your state law. You are subject to the state law that governs nonprofit organizations in your state. And every state is slightly different. And every state will have their own requirements with respect to board governance. So for instance, some states require by law that your board have at least 3 members. Other states don't have a requirement for a number of members, but many states will require a minimum number of board members. Some states require a minimum number of meetings. Some say at least 1 time per year. Others might have requirements to meet more often. So you have to be aware of what's going on in your state, what's required in your state, and obviously we here at the Council can't in an hour talk about every state, but we are very happy to help find out what it is in your state. We have access to tools where we can look up various state laws and help you find what might be applicable in your state. So that's an important point I want to make. Do not forget your state. Here at the Council, being in Washington, D.C., we're very focused on the federal law and particularly the Internal Revenue Code, but I never want to forget about the states and the state law that applies to all of our members. So, several benefits to adopting a set of board policies, and everybody's set of policies can be a little different, but policies help you with continuity. Say somebody is hit by a bus, and you know, the institutional knowledge may go with them. Policies help you understand how your organization is supposed to run and allow successive board members as well as successive staff to understand what are the rules and the procedures at your foundation. Board policies also help ensure that you have objective and non-discriminatory grant making. If you can point to a board-adopted policy about grant making which talks about how you will make objective and non-discriminatory decisions when it comes to your grant making, that's really great evidence of compliance, that you are complying with those type of goals to be objective and non-discriminatory. Board policies also help with your transparency and public accountability. Being able to point to policies and say, this is how our board does X, Y, is great to show the public. You've already thought about it, you've got a procedure in place, and you follow it. And then I've put down here defensive documentation. If, heaven forbid, you ever get into a lawsuit or some kind of legal issue, policies are great defensive documentation to show, again, that you've thought about the issue, you have a policy in place, and you follow it. So we talk about, I mentioned that that there are really actually very few legal requirements with respect to policies. You know, I very much deal often with the Internal Revenue Code and the IRS Requirements. And if you guys are familiar with IRS Form 990, which is your annual tax return, if you will, Section B of Part 6 on the 990 includes quite a few questions about board governance. And among those questions, the IRS wants to know, do you have a conflict of interest policy? Do you have a policy regarding relationships with affiliates? Do you have a whistleblower policy? Do you have a document retention and document destruction policy? Do you have a procedure for determining your executive compensation? And do you have a policy regarding joint ventures if you were to ever enter into a joint venture? So these are being asked on the 990. The IRS wants to know, and if you're doing any of these things, you need to have a policy in place to show compliance with the IRS.
And if I could just harp on that, Suzanne, when I was at this conference in Austin, I was surrounded by several attorney generals of several states, and this is the point they were making, that these parts of the 990 are very important, and they actually look for these if it is required. So really, really important that you follow these rules on Section B, Part 4.
Part 6.
Six, yeah.
Yeah.
I can't do
Roman numerals, I know,
yeah.
sorry. Okay. So on the next slide, continuing on with IRS requirements, many of you may not have even been around when your organization was first incorporated or first applied to the IRS for tax-exempt status, but if you are a newer organization, you may remember filling out your IRS Form 1023, which is your application for tax-exempt status and charitable status. And as part of the 1023 application, the IRS wants to see your organizational documents. They'll ask for a copy of your Articles of Incorporation and also your bylaws. And what they're looking for, particularly with respect to these organizational documents, is that you clearly express a prohibition on private inurement. That's a very important requirement under 501c3, that your assets not go to benefit private individuals. So they want to see that in writing somewhere in your organizational documents. They also want to see, and this is a requirement, that you have in your organizational documents a sentence, a paragraph, something addressing what would happen to your assets if you dissolve. That, another legal requirement that they're going to look for. They could reject your application if they don't see that. And finally, on the 1023, if you are an organization that awards scholarships, even just one scholarship, they're going to ask you that, and they're going to want to see that you have policies and procedures in place to make sure that the scholarships are awarded on an objective and non-discriminatory basis. So there's actually a separate schedule to the 1023 you would have to fill out if you're going to do scholarships. Many of you have probably heard about the Sarbanes-Oxley Act back in 2001 in response to the Enron scandal and some other things. They passed a law that generally applies to the big publicly traded corporations, the for-profit corporations. However, it has been generally accepted that certain parts of Sarbanes-Oxley carry over to nonprofit organizations, and those include the whistleblower policy and the record retention and destruction policy. So hopefully you guys all have those in place. That has now been around for 15 years. If you don't, we here at the Council have sample policies. We're happy to help supply and give you samples, but those are absolutely required for good governance, that you have both a whistleblower policy and just one quick note about the whistleblower policy. It's not enough to say, you know, what your procedure is if somebody wants to report something, but you need to address retaliation, or actually no retaliation. Your policy must state specifically that you will not retaliate against somebody who decides to report something they think may be going on improperly. So the no retaliation part of a whistleblower policy is important, and we have seen here at the Council, you know, I think with the National Standards Program for Community Foundations, the applicants submit their policies. We've seen whistleblower policies that talk about how to report something, but don't say anything about the no retaliation. So that's an important part of a whistleblower policy. Again, if you need any further information on these, you're welcome to contact us here at the Council, and we can give you some samples. Other policies to consider. Okay, these are not legal requirements, but things to consider, and I'm addressing the community foundations out there right now because community foundations are the ones that generally will have the donor-advised funds. Inactive funds policy for donor-advised funds. That's something you might really want to consider right now. There has been some criticism about donor-advised funds lately, and some negative comments that certain people out there think that donor-advised funds are just parking money and are not being useful. We've seen the statistics. We know that donor advised funds are paying out and are being very, very useful in the charitable sector. But, you know, there are critics out there. One of the ways you can counter critics is with an inactive funds policy, a policy that your board has adopted which says if you have donor advised funds and your donors are not active, they haven't made any grants in several years, we'll take some action. We'll contact the donors. We'll encourage them to make grants. We will, if they really don't want to be active, we may assume the fund and and transfer it into a different type of fund. So lots of options with an inactive funds policy, but it's something you might want to consider. If any of you have funds and donors where the donor asks that you consider using their own recommended investment manager, you're probably going to want a policy on when and how you would do that. That's a popular question I get. Can a donor recommend a separate investment advisor different from the person or the firm that you normally use for the rest of your foundation assets? It is legally possible, but again, a policy on how and when that would happen is really important. You can also make it your policy that you don't allow that. That's perfectly fine as well. But having a policy in place is a great resource when you get that question, and you can point to that policy and say, well, our board adopted this policy and this is how it has to be. So we have samples of those as well. Then finally, the one I have up here, a donor-initiated fundraising policy. This is a popular question as well, especially among the community foundations, that they have funds where their donors want to do fundraising, want to have events or other methods of fundraising to get money into their fund. Again, it's legally possible, but you need to know the implications and the risks of that. And a policy will help you outline when and how a donor may do their own initiated fundraising for their fund. Again, as with the investment manager policy, you can always say, no, we don't allow that. That's certainly an option, and you're right to decide that. But if you want to allow it, a policy is definitely important to outline how that's going to work. The 990-PF. Okay, we got a question about similar questions on the 990-PF, and you're absolutely right. There are similar questions. There are questions on the 990-PF about board governance. I don't have that page in front of me, but they are very similar to what we had up. In fact, I probably should have put 990/990-PF. The IRS is looking for those things. One thing in the 990-PF that would not be in the regular 990 is questions about self-dealing. There are questions about have you engaged in any transactions that may be self-dealing, because when you do engage in a self-dealing transaction, there is a penalty tax that goes along with that. So they're asking in the 990 if you've engaged in any potentially self-dealing transactions, and then there's a method for you to explain that and potentially have a penalty tax assessed against you. So good question. Yes, 990-PF has very similar questions, and if the person that asked that question wanted to email for even more details, I'd be happy to send them a full explanation via email. So the next slide, and we're going to move through this pretty quickly because, again, we only have an hour. So any further details that you want, you'll have our contact information up at the end that you can email us directly. But the next topic is conflict of interest. Again, and you've probably all heard about this. Just a few important points. Having a written policy is key. You'll also find that many state laws require a written conflict of interest policy. If you are a public charity, a conflict of interest doesn't necessarily mean that whatever the activity is prohibited. Actually, even if you're a private foundation, something may be a conflict of interest, but if it is not self-dealing, it's not technically prohibited. You just have to subject it to your conflicts policy. And what I mean by that is you have a written conflicts policy. It should talk about when is something a conflict, how the person that has the conflict discloses it, and then requires that the person who has the conflict not participate in any decision making. That's very important. Abstaining from the decision making, abstaining from the discussion is important. The conflicted person could provide some information if the rest of the group needs that, but they cannot influence or participate in the decision making. So for instance, if the conflict were that the board wanted to hire a new accounting firm to perform their annual audit, and one of the board members was a partner at that firm, that's obviously a conflict of interest. If they hire the firm, that board member who's a partner could share in the compensation probably, so there's a conflict. But it doesn't mean that it is prohibited. What you would do is that board member needs to disclose the conflict, and then the rest of the board vote on whether or not to hire that firm, knowing full well that one of their board members is a partner there. So disclose, well, I put up there disclosure, disclosure, disclosure. This is really important. You can't deal with a conflict unless it's disclosed. But disclosure is absolutely key. And I also have up there addressing perception of a conflict. We've found here at the Council that foundations really run the gamut from ultra-conservative in their governance to maybe not quite so conservative. So as a foundation, you may want to address in your policy, even if something is not technically a conflict per your definition of a conflict of interest, do you still want to prohibit the transaction or address it as if it were because of the mere perception of a conflict? That's something you can address in your policy. So if you're a very conservative foundation and you want to not only identify true conflicts but also anything that may even be perceived as a conflict, you can put that in your policy that those must be disclosed as well. All right, so just a couple more notes on conflicts of interest. The IRS actually has a sample conflicts of interest policy. It was, I think most recently, an addendum to the IRS Form 1023. But if you have trouble finding it on the IRS website, please let us know. We can shoot that to you as well. It's not required that you use the IRS sample policy, but it's a good guideline if you don't have one or if you want to compare what you have and maybe update it. Distributing the conflict of interest policy to all your board members and having them acknowledge it is also a good governance point to make, that obviously they can't comply with a policy that they're not aware of. Many foundations will ask if there actually has to be an annual reaffirmation every year. Do the board members have to re-sign the conflicts of interest? This is something you would deal with in your policy, whether or not you do that, although some states actually do have requirements about this. I think in New York, the law says that they have to disclose on an annual basis. The board members need to disclose on an annual basis whether they have any conflicts of interest. So any businesses they're associated with, any other boards they sit on. In New York, you have to disclose that annually. How you disclose that, would be filling out a form every year to say, here are the businesses I'm associated with, here are the boards I sit on. New York law doesn't go into that specific, but that's certainly a way to satisfy what New York requires. So that's something you would put in your policy if your state law requires some kind of annual disclosure. And the last point on this slide, so I've mentioned self-dealing a couple times already. Self-dealing is a rule, or it's actually a section in the Internal Revenue Code that is applicable only to the private foundations. And if you are a private foundation and you engage in a transaction which could be viewed as self-dealing, or which fits the definition of a self-dealing transaction, you can be assessed a penalty tax. Self-dealing transactions are, I think, almost always conflicts of interest. Conflicts of interest are not always self-dealing, though. So it's important to understand the distinction. Conflicts of interest are a little bit more broad. A lot of things can be conflicts while they may not technically meet the definition of self-dealing as it's set out. And I think it's section 4941? 4941 of the code. So with that, we're going to go right into self-dealing. And again, this is for the private foundations out there. Up there it is section 4941. And what that does, it prohibits certain financial transactions with disqualified persons. It also prohibits financial transactions with third parties that provide a benefit to these disqualified persons. And as I said, a penalty tax can be imposed for violations. These self-dealing transactions, I've listed them up there. I'm not going to read them all, but basically, you know, financial transactions like selling and leasing property, lending money, advertising for a disqualified person, that comes up a lot with corporate foundations, and providing, you know, business opportunities and things for disqualified persons. Those are the types of self-dealing transactions that are outlined in section 4941. So you may be asking, okay, so who are the disqualified persons? They are generally your foundation managers, your officers, all the board members, directors, trustees, whatever you call them. Those board members are your disqualified persons. And then also employees of the foundation that have authority to act on behalf of the foundation. It does not actually technically include every single employee, but it includes employees that have authority to act on behalf of the foundation. Also substantial contributors to the foundation, including a parent company. If it's a corporate foundation, the company itself is going to be a substantial contributor, and the company then would be a disqualified person. Then we have the family members of the above. There's a provision for certain government officials and business entities, other businesses that have at least a 35% ownership of a disqualified person. So your board members, businesses where that board member owns at least 35% of the business, that business itself is also a disqualified person. So that means you can't do those transactions with that business. Okay, there are, fortunately, certain exceptions to the self-dealing rule. These are also in 4941. So paying compensation for personal services that are reasonable and necessary to carry out the purpose of the foundation, if the compensation is not excessive. And the personal services are generally the professional type services such as legal, accounting, financial management. You can pay somebody who would be a disqualified person for those services if the compensation is not excessive and it's reasonable and necessary to carry out your purpose. Now, going back to the conflicts of interest, that still might be a conflict of interest that you have to process through your conflicts of interest policy, but it may fall into this exception of self-dealing and not be a self-dealing transaction. Also, as an exception to self-dealing are what the IRS refers to as incidental and tenuous benefits, like public recognition. So if you're a corporate foundation and you recognize the company with a banner or a logo, or somehow recognize the company as a critical donor to your foundation, that's okay. That will not be self-dealing. Consumer goodwill that flows to the company because of their contributions to the foundation is also an incidental benefit that's not self-dealing, as well as increasing morale of company employees. Those kind of things are just incidental, and the IRS doesn't consider them self-dealing just because the company gave money to the foundation.
If I could just make one distinction here. The public recognition for the company is different than advertising. Mm-hmm. And so when they talk about incidental or tenuous benefits, you have to toe the line and make sure that the benefit you're getting of the recognition isn't something that you're helping that company get in terms of advertising for them.
Yeah, that's a great point. And we have done presentations just on corporate foundation issues, and this does come up a lot in the corporate foundation world, how you can recognize the company for their contributions to the foundation and then the foundation's work in the charity world without crossing the line to advertising. So if you want more information, we've got things about that specifically. Some of the decisions from the IRS help guide us into what is advertising and what may not be advertising. So I'm going to pause for just a second because we're about halfway through, and we're going to move on to a different topic, but also, as I said earlier, a very popular one right now as far as the board's responsibility for the investment oversight of the foundation. So hopefully everyone out there that is with a foundation, your foundation has assets, has significant assets, and you're investing those assets and getting a return on those assets, although I think right now things are down a little bit. But anyway, they'll pick up, I'm sure. So you're investing your assets. What is the board's responsibility with respect to management of those assets? And what the most important point I want to make here is that if you are sitting on the board, your board has the ultimate governing authority for the foundation and its assets and can never truly fully delegate that responsibility away. So even if the board hires a professional firm or a professional investment manager to take on the investment job of investing the foundation's assets, that does not relieve the board members from the full responsibility. And the way this plays out in real terms is so you as a board hire, interview, look at proposals, and hire the best investment manager that you can find for your assets. Your liability as a board would be rooted in your decision to hire that manager. So if that manager does a terrible job and you lose lots of money on your investments, the claim or the complaint against the board will be you were negligent in hiring that firm or that individual. So what you will want to do as a board is take great care in that decision. No, you're not actually making the decisions on what stocks to buy, things like that. That's what your investment manager is doing. But your decision was to hire that person or that firm in the first place. So you can see you can never fully escape the responsibility for how your assets are managed. And going along with that is that you're going to want to monitor and receive reports from your investment manager, from any individual or firm you hire to manage your investments. If you're not paying attention to the results, to what that manager is doing, you could also be subject to a claim of negligence on that part because you haven't monitored what they're doing. You're not getting periodic reports from that firm. And you know, things could be going downhill and your board would not know if they weren't getting reports back. So there are ways that a board could be seen as negligent when it comes to investment of their assets, even if they're not actually performing the investment function. So that's why I say you can never fully delegate that away. You cannot write into a contract with an investment manager that investment manager takes on full fiduciary responsibility for all the investment decisions. Ultimately, the decision to hire them is yours and as a board, and you have to take responsibility for that. One other thing on this slide I've noted is the Uniform Prudent Management of Institutional Funds Act. You guys have probably all heard of MIFA. This is a state law, so here's an area of state you need to be aware of. It's a uniform act, so it's very similar from state to state. There are a few differences, so you need to be familiar with your own state of MIFA law. But what it does, its main function is to provide guidance to charitable institutions or nonprofit institutions on how to manage investment assets. And I do want to make a point that a MIFA applies to your assets that are in endowment. An endowment is where the principal is invested and only the income is spent. So if you've got funds in endowment, you need to know about it MIFA. If you have no funds in endowment, if you are strictly an in and out foundation, and some corporate foundations are like that. Some corporate foundations get contributions from the corporation and spend them out on grants, and there's no real endowment, then the provisions of MIFA may not apply to you, because a MIFA is strictly on endowment funds. So if you have endowment funds, be aware of MIFA. It gives you guidance on how to invest or prudent investment management of those funds. One common way that boards deal with investments and finance issues is to appoint an investment or finance committee. And this is generally a committee of board members. You can have outside advisors participate in the committees, unless there's a state law provision that prohibits that. But you can delegate to usually it's the board members who have some background in this area. So your board members that are bankers or accountants or investment managers may want to sit on the investment and finance committee. And that committee can be responsible then for putting together an investment policy, maybe some guidelines on how you're going to manage your investments. Also, the hiring of outside investment managers and firms to manage your investments. That's another role that the Investment and Finance Committee can function as. It's a committee basically of the board, a subcommittee of the board, but acting on behalf of the board to take on this role. I've put a few notes up here about what an investment policy statement might have. You know, what are your investment objectives? Are you wanting to maintain your endowment for the long term, or are you more concerned about maximizing current returns and making sure you have a lot of money to grant out? The roles and responsibilities of the committee or other individuals with respect to your investments and finance. Performance expectations, this is where you can make note of your investment expectations, whether you are conservative in nature or a little less conservative. You can also note spending needs or even include a spending policy. And that's something that a MIFA allows you to do, is to come up with your own spending rate for your endowment funds. You're not legally required to limit your spending to the actual income of the fund, but your board can decide on an annual spending rate, and this is pretty common, I think, among our foundation members. I hear spending rates right now around 4.5% seems to be pretty popular. Carolyn's nodding her head because she hears this a lot. Your investment policy can also outline prohibitions on investments, certain things you may not want to invest in regardless. It's also a place where you can outline investment policy with respect to mission-related investing. If there are companies, socially responsible companies, that you as a foundation feel important to invest in, you can outline your ideas and your goals in that respect as well. As I said, the Investment Finance Committee can generally responsible for hiring or recommending investment managers. They can do an RFP or take proposals. It's always important to get a written engagement letter with the individual or the firm. Having the ability to terminate that relationship is very important. Again, going back to your role as the board and your potential responsibility, if you can't fire a poor investment manager, then you've got a problem. So making sure you have the ability to terminate that relationship. And also this performance measurement, are you getting those periodic reports? Is the investment manager providing good, understandable investment performance reports for you on a periodic basis so you can evaluate how they're doing. And then finally, making sure that the fees that are charged by investment managers are appropriate. And I think we have information like that, don't we, Carolyn, on fees, right? Our Knowledge Center is terrific as far as compiling information like that that may not be technically a legal question, but seeing what's happening in the field. Super helpful to contact the Knowledge Center for information like that if you're wondering what fees investment managers are charging out there. Okay, so that we're going to wrap up a little bit on investment oversight and move on to mission measurement. And I see we're getting about 15 minutes left, so hopefully we'll get through everything. But mission measurement. So this is an issue, a hot topic right now that funders want to know how their money is being used. So you as foundations are the funders. You're making grants to organizations and wanting to know how those organizations are using your money in a way that supports your mission, or making sure that they are using your money in support of your mission. And your board should be getting reports from staff or from consultants on how your grants are doing. If you're making grants and not getting any feedback on what's being accomplished, you know, you may be doing only half the job. So there is a growing pool of consultants out there that can help you with mission measurement. It's getting to be a more popular line of consultation that can be very helpful. They can provide you that data that helps you determine what grants are working, what grants are not, what organizations, what grantees are really accomplishing things, and what grantees may not be accomplishing. Sometimes the results of the data and the information, the research is, you know, larger grants are needed to really accomplish things. Fewer larger grants may be needed versus many small grants, or it could be the opposite. But that's the kind of thing that you can find consultants to help you with. Because again, if you're just making grants in response, if you're just reactive to the requests, you may not be doing the full job of accomplishing your mission. And this is an area you might consider if you haven't yet stepped back to look at how are we accomplishing our mission right now with our grant making. I just wanted to put this in here. Question to ask: who or what purpose does your organization serve, and what change do you seek to create and when? If you don't know the answer to that question, that's probably the first place to start. You need to know what your purpose is and what are you trying to accomplish before you can really measure whether your grant making activity is accomplishing that. I've included a slide on some performance measurement life cycle. I'm not going to go through this in detail, but that's just something you might want to look at. Talking about performance measurement and how the cycle of that goes as far as collecting the information and then analyzing it. Okay, so kind of along the same lines, I wanted to bring up mission drift. So say you know the answer to that question of what you're trying to accomplish, and you have some pretty good data to show that your grant-making activity is accomplishing what you set out to do. But over time, and this is common in a lot of foundations, the mission starts to drift. And new board members come on, and new board members have different ideas about what they think the foundation should be funding, what they think the foundation should be working toward, and start to get into new areas. And I see this actually, I've had quite several questions from family foundations that the initial family foundation was organized years and years ago with the initial donors who have since passed, and subsequent generations are now running the foundation. And the later generations have different ideas about what they want to fund and what they want to accomplish with the foundation dollars. There's nothing necessarily wrong with expanding your mission, but you have to look at your organizational documents and the way your foundation was set up to see if there could be any issues if you start expanding out from the original mission. Excuse me. Let's see. So if I put up here some signs of mission drift. So if your board members cannot clearly articulate what the foundation's mission is, you may be in mission drift. If you are chasing dollars and building programs around the dollars that you're receiving, you may be straying from your mission. If you're questioning of whether you're violating ethical or legal standards, that could be a sign of mission drift. If you have a core group of board members pushing the foundation in a certain direction, which is completely different from the original foundation mission, certainly that would be a sign of mission drift. And if you have a large turnover of staff or board members, again, you may be straying from the mission. The people that originally joined the foundation to carry out the original mission may be dissatisfied that you're no longer following that and getting into different things, and as a result there's a large turnover. So these are just signs. If you have any of these signs, you may want to step back and say, hey, are we in mission drift? Are we still accomplishing the original mission of the foundation? I mean, if you have to pull out your bylaws or your articles of incorporation, do that. See why your foundation was established in the first place, and see what the mission is and how closely you are still accomplishing that. All right, so in the last 5-10 minutes or so, we're going to go through some public disclosures. And because I do get this question a lot, what legally are we required to disclose and what do we not have to disclose? So for the IRS, and this is right from the IRS guidance, exempt organizations must make available for public disclosure and provide copies upon request. So you do have to photocopy if somebody requests it, your annual 990 or your 990-PF or your 990-EZ, depending on which one you file. You also have to provide your application for exemption, your IRS Form 1023. And now before I hear the calls that we were formed 70 years ago and we don't have our 1023, that's understandable, and the IRS may not have copies of it either anymore, but you can provide your determination letter. You should hopefully still have a copy of your determination letter, or sometimes you might get an updated determination letter. We at the Council requested an updated determination letter just a few years ago, so we have that available. But that shows that you are approved by the IRS as a 501c3 charitable organization and tax-exempt entity. Certainly, if you're a newer organization and you still have a copy of your 1023, you want to make sure to keep that in your permanent files so that you can always be able to present that for inspection or make a copy of it if somebody requests. The law does allow you to charge a reasonable fee for copying, and it does say that you have 30 days for written requests or immediately if somebody requests in person. Somebody shows up your foundation office and requests to see something, you are under the law supposed to provide it immediately. There's a penalty in the law of $20 per day up to maximum $10,000 for failure to publicly disclose. Now, one question I get a lot is whether or not you satisfy your public disclosure because you have your 990s on GuideStar. Somebody could go on GuideStar and pull down your 990. While that's helpful, technically it's not going to satisfy this if the person is asking you for a copy of it. So you have to, how to satisfy the public disclosure requirement often depends on how it's requested. Now, publishing on your website is going to satisfy. And this next slide includes some very specific details about 990 disclosures that, again, I don't think I'm going to read all of them, but the important points are that even the schedules and attachments are required, except there is an exception for names and addresses of contributors. For the public charities, like the community foundations, don't have to disclose their names and addresses of contributors, which is generally listed on your Schedule B. You can redact those names, but other than that, the schedules and attachments must be included. So there's a point there that if it's made it publicly available through an internet posting, but you also have to make it available for in-person inspection. And the IRS instructions to Form 990 are very helpful as far as outlining, again, what are the legal requirements for public inspection of 990s and 990-PF. So wrapping it up here, so again, 990 reporting and audits, going back to the whole purpose of this webinar, which is the board and board governance. So we already said the board's responsible for financial oversight of the foundation. If the board's responsible for financial oversight of the foundation, it makes sense that the board needs to be aware of what's in your 990 and your 990-PF. That's your return. That's your tax return, if you will, for the IRS. Reports on your income, your assets, your distributions. The board needs to be aware of that. In fact, there's a question in the 990 which says, has the organization provided a complete copy of this form to all the members of its governing body before filing? So hopefully you are all answering yes to that you distribute the 990 right before you're ready to file it with the IRS, and the board has the opportunity to look at it, to make comments, to ask questions, and then you file it with the IRS. That is the way the question is worded. The timing of that, sometimes I hear that foundations are providing the 990 after it's been filed, but that's the way the question on the 990 is worded. Has the organization provided a complete copy of this form to all the members of its governing body before filing the form? Many state laws require foundations to be audited, and this is another popular question. Do we have to have an audit? The IRS doesn't have, it's not where you look for this answer. This is a state law issue, and many state laws do set out audit requirements for their nonprofit corporations, and they're often dependent on asset size. So, for instance, the state law may say that for organizations with assets over $1 million, you have to have an independent audit. Smaller organizations oftentimes do not have those same audit requirements. But this is an area you've got to be familiar with your state law to really determine whether you're compliant. Other state law issues, charitable solicitation registration. You guys are probably familiar with that. 40 states right now, I think, require a registration at the state level to solicit donors, solicit contributions in that state. Many state registration requirements are dependent on, have a minimum dollar threshold. So for instance, if you solicit or if you receive $25,000 or more annually, you have to register. If you're below that mark, you may not have to register. That's an example from Pennsylvania. I think that's the threshold in Pennsylvania. Many of the registrations ask you to submit your 990 as part of your registration form, and usually these registrations are annual, so you have to every year update your registration. As I note here, they may not always mirror the federal law as far as disclosures. California is now requiring the Schedule B list of donors, names and addresses, whereas the federal law you don't have to provide that. And then there are additional state law provisions that you might need to be aware of as far as lobbying or electioneering. Some states require additional reporting if you engage in any lobbying activity. And electioneering, hopefully nobody's doing that because charitable organizations are not supposed to be involved in elections. Okay, so here we are wrapping it up. How are we doing on questions? You got any questions that need to be answered? We're good. Okay. So I just, as a review, I wanted to list what I thought were the responsibilities of the board. So you can see determining the mission and purpose, selecting your chief executive if you have a paid chief executive, and supporting that executive, planning and monitoring your programs and services, ensuring that you maintain adequate financial resources for the work that you're doing, and protecting the assets and providing proper financial oversight. We talked about that a lot today. Building a competent board. If you're on a board and you don't realize that part of your job is recruiting new board members and continuing to keep and maintain and add to a competent board, that should be part of your responsibilities. Ensuring legal and ethical integrity, and enhancing the organization's public standing. These are generally viewed as basic responsibilities of board members. And then I know Brian's been itching to talk about this. So we talked a lot about what the roles and responsibilities are, but what's your risk if you do something wrong? If as a board you make a bad decision, what are your risks? Generally under state law, and again remember I said that boards are creatures of state law, so you have to look at what your state provides. But generally under state law, there's something called the duty of care and the duty of loyalty. There also may be something called a good faith standard. And basically what that means is if you serve on a board, you act in good faith, you take care with your decisions, you rely on expert opinions when it's warranted, when you may not know, if you're not a finance person, you rely on experts in that field, and you stay loyal to the organization, you're going to be protected. You're not going to be personally liable for a bad decision. Even if there is a bad decision, as a board member, you would not be held personally liable for that decision if, again, you act with care, you act in good faith, and you make decisions after considering, advice of experts and considering making informed decisions, I guess. Did you want to add to that, Brian?
Yeah, I think the big thing here is distinguishing the difference between a for-profit corporation and a nonprofit corporation. Because in a nonprofit corporation, the constituency here is the purpose. And for a for-profit, obviously you will want to make money for the shareholders. And for nonprofit corporations, there are no shareholders. One example that I can think of that was very recent, where a foundation thought more of the bottom line than the purpose, was unfortunately the Second Mile. You remember that the Second Mile Foundation
in Pennsylvania
with the Sandusky there. You can make the argument that they were looking out after the bottom line rather than the purpose of the foundation. So that's where you really need to be careful there. And Suzanne was talking about risk. Do you know insurance? Do you know insurance?
Oh, do you know insurance? That's
very important. Yeah.
That is helpful, and we've had. I think the previous webinar we did in connection with GuideStar, we talked about insurance, right. But that helps to protect your board as well. Okay, so looking at any questions,
sure.
Can you read them?
Sure. Okay, we have two questions here. The first one is, if you are in the process of incorporating and seeking 501c3 status,
okay.
What, if any, rules are there for seeding your association's bank account to pay for activities and programs?
For seeding the bank account. I'm going to take this with respect to like a board member.
Yeah.
Asking. Okay, so you're organizing a new charitable organization. You're incorporating and you're filing for your 501c3 status with the IRS. It is not illegal to loan the organization startup funds to get started. Now, ideally, I think the IRS would love to see donations to seed the initial startup costs, but we all know that there are costs involved. In fact, the IRS application 1023, I think the fee is up to something like $850 now. So, I mean, it's a tricky situation. An individual could loan the organization money and could be paid back at some point in the future once money is raised. It's not illegal unless you're a private foundation and it falls under self-dealing. But if you're not a private foundation, you're a public charity, you could enter into a loan agreement where you loan the organization money for startup costs. It's more the appearance of whether or not that looks good and what the terms are of the loan. But I mean, all I can say, I think, in response to that is that it's not illegal. And I know it has happened. It's definitely happened that an organizer loans money or fronts the upfront costs with the expectation that they will be paid back. Now, obviously, that person would not get a tax deduction because it's not a donation. It's a loan to a new organization that will be paid back. But if that person ends up being on the board or being the main employee of the organization, it's not going to look great. And there are questions on the 990 and I think on the 990 PF that ask, have you entered into any transactions, including sales or loans, with board members, with key employees? You're going to have to report that. So if you decide to do it, well, I said it's not illegal. If you decide to do it, you are going to have to report that on the 990, and the IRS will see that you've done that type of transaction. So just something to be aware of. Second question.
Well, I guess related to that, can expenditures by future board members be reimbursed for example, for meals, supplies, for planning meetings once your organization begins fundraising?
That's a great question. Okay, so generally, first of all, I'll say there is no legal prohibition against compensating board members. I think most foundations have board members who serve as volunteers. But that does not mean you cannot reimburse them for expenses with respect to travel or other things they need to do to perform their board service. This is something you would want to outline in a policy, though, and put some guidelines on it. For instance, if you're going to reimburse board members for travel, it's pretty common to have a travel policy, travel reimbursement policy that says you can't, you know, fly first class. We'll reimburse coach class, things like that, because you're a nonprofit organization and you're expected to reimburse expenses in a reasonable nature. But there's actually no legal prohibition against compensating board members. So if you're inclined to reimburse board members for their expenses or to even provide some reasonable compensation, again, outlining that in a policy, you're going to be reporting things like that on your 990 as well, so the IRS is going to be able to see that. But it's not prohibited, and so certainly reasonable expenses can be reimbursed, and of course your policy is going to want to include things like, you know, they have to submit a receipt and full, you know, document the expenses so that you know what you're paying for. So, but that's possible. That's doable. So are we good? All right. So we ran a little bit over time. I apologize, but with the technical difficulties, I think we needed to. And I do appreciate everyone's calling in or dialing in for this. And our contact information is up on the last slide. Please feel free to email me or call if you need any follow-up on anything we've talked about today. And again, I appreciate everybody participating.
Thank you.